I think what's clear is central bankers need to catch up to their economies. They've been behind the curve.
There's a chance that we are already in a recession.
It's going to have to go to about 5.5 or 6%.
The one thing that people are not prepared for is interest rates resetting meaningfully higher.
Then if the Fed reverses course, they're going to look like they're weak on inflation. So this is a very, very tough situation that we're maneuvering through.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in Zurich following the S&P decision, and here's what's coming up on today's program. The Fed takes aim at inflation. The central bank raises rates by 75 basis points, its biggest hike since 1994. The S&P follows suit with a surprise 50 basis point hike. We speak later with the former head of the Swiss Central Bank, Philip Hildebrand. The Bank of England up next, and risk sentiment turns sour as recession risk takes primacy of central bank resolve. Stocks and futures deep in the red. So let's get straight to our top story. The Fed moves its bumper move, or it makes its bumper move, hiking 75 basis points, the central bank's biggest rate hike since 1994. Now, the chair, Jay Powell, asserted the Fed's commitment to reining in price pressures, indicating another big move in July.
We're strongly committed to returning inflation to our 2% objective. Inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
Meanwhile, the ECB says it's working on a new tool to curb market stress. It follows an emergency meeting yesterday, convened after Italian yields surged to the highest since Europe's sovereign debt crisis. So for more on all of this, we're joined by Michelle Jamrisco and Bloomberg's Maria Tadeo. Michelle, let's start with you. The Fed delivering its big move. How much more will the Fed need to do?
Well, that is the big question. It always starts right after the meeting. We look to the next meeting. And of course, you heard the Fed chair saying there that 50 or 75 is on the table for the July meeting. I think what was important here is his language around 75 being unusual. Of course, that was a bit of a dovish tilt in that message. But overall, the underlying message was clear. They had to go big. They did go big. They revised their inflation forecasts upward. They revised their growth forecasts downward. They acknowledged that it's not going to be the sort of soft landing that they had seen previously. We're now looking at rates ending up somewhere in the range of 3.4% at the end of the year, whereas before it was 1.9% as of March. So there it really is a message that they had to go big. They did go big, and we'll see the consequences as we move forward. But now we will be in that debate about how much bigger do we have to go, and what, importantly, what are they looking at? Inflation expectations, core inflation, or something else?
Yeah, Michelle, thanks so much. Maria, of course, the ECB didn't exactly deliver what the markets wanted, but they delivered something, which is, I guess, a little bit less market volatility.
Yes, Francine, absolutely. And I think, I had a contact yesterday who really encapsulated the state of play very well. The ECB yesterday did what it should have done a week ago. The statement, what they promised now openly to create a new tool, although there's a lot of details that we don't know, doesn't give you reasons to sell the market, doesn't give you reasons to buy the market. But for the time being, it has just stabilized BTPs if you look at where they're trading today. I guess for the time being, that is good enough. But Francine, there's a lot of questions in terms of the announcement, the tool. When will it be ready? Will it be the July meeting? Also, what does it mean for the rate hike? And to me, one of the key issues here is the conditionality attached to it, because there is no free lunch. And the idea is that there will be some type of soft, light conditionality around the tool.
Very low.
Maria, thanks so much, Maria Tadeo there, and Michelle Jamrisco. Now, we're also watching the Bank of England. It's set to deliver a fifth straight rate hike today, with officials expected to stick to its steady path amid global chaos. Now, here in Switzerland, the S&P also just delivered a surprise hike of 50 basis points, and the governor, Thomas Jordan, says the central bank will consider currency sales if the franc weakens. Well, amid all of the movement from central banks, the positive sentiment in stocks overnight has evaporated as recession fears seep into the markets. Now, futures futures in the US and stocks in Europe are now deep in the red, and the rise in yields has continued. Now with us is David Cole. He's chief economist at Julius Baer. David, great to have you on the program. Look at this beautiful office. We're just inaugurating, and I'm happy we're inaugurating with you our new Zurich office. I mean, the S&P was really a surprise. Does it really go to the angst of every central bank? Inflation in Switzerland is not that high, 2.6%, but they worry that actually, because of this global tightening cycle, they get stuck out.
Well, I would rather see it as an opportunity, and the S&P was brave enough to use this opportunity to normalize. And we have, of course, inflation globally is high. That's probably the starting point for every central bank right now to normalize. Although you said it, in Switzerland it's like 2.9%. That's nothing against like this 8%. We think other moves or other things are much more important for this S&P. And the first one is what we heard from the ECB. They do something against fragmentation. And that's in particularly puts away pressure from the Swiss franc. So it opened really this huge opportunity for the Swiss National Bank to go to more normal rates. And the Swiss National Bank is worried actually about these deeply negative rates, the excesses which are happening on the real estate markets, on the credit aggregates, and
David,
so on.
What will happen to the franc, the Swiss franc from here?
Well, so far it digested that very well in terms of, the S&P is always worried about too much strength at the Swiss franc. This is less of a fear right now. In an environment where you have to worry about inflation, a strong currency is a good thing. Yeah? In particular, when inflation is coming from outside, when it's imported, a strong currency helps really to cushion this effect on the domestic side, and this is exactly what we're seeing for the S&P.
David, I mean, overall, I feel like the S&P. First of all, where were the economists on this? Like, why did no one predict this were happening? And is it going to put a lot more pressure on central banks around the world? Is this the first moment where we say, wow, if the S&P hikes by 50% and no one was expecting it? I mean, I think one economist was expecting 25 basis point hikes. It means there's a real inflationary problem.
That was really the big surprise, and we wonder why the S&P or officials of the S&P did not signal that to markets. I mean, that seems to be like that central banks are really wanting to
the markets were expecting it more than economists. Like, what's going on?
It seems like that central banks are really erased all this put call for financial markets, so they don't want to support financial markets. They want actually more volatility, simply probably to address also these problems of misallocation of capital. We're coming out of a time of very cheap money, so what follows is always some kind of misallocation of capital. We've seen that less in Switzerland, actually, but really this is a big surprise. Not why the S&P hiked rates, but rather why they had not signaled that beforehand. I think still the S&P has all the time not to hike rates really to a very strong level, but rather normalize interest rates.
Do you think it was because of the Fed? So my executive editor sent me here, and he was like, the S&P is the most important decision this week. And I was like, really? Actually, will this turn out to be a pivotal point in when we realize that inflation is a real problem across the world?
Well, again, inflation is not a problem in Switzerland.
But it could be. They're preempting. They're front-running.
I wouldn't say so. So first of all, you have really this strong currency which helps to cushion the imported prices. So this helps definitely in Switzerland. And then you don't have the same excess demand problem in Switzerland like you have at extreme really in the US. A little bit in the Eurozone, not as much, and none in Japan, which is another central bank which is apparently not acting.
David, overall, I mean, when you look at the Fed, interest rates in the U.S., interest rates in Europe, where do we end up? Is 5% something that we need? I mean, if we have inflation at 10% in the U.S., we're going to have interest rates at 5% to deal with that. Well,
listen, we think that what the Fed is doing right now, it's highly appropriate. Go 75 basis points in June, go 75 basis points in July. That's highly appropriate at the current situation. But look at the projections of inflation for next year. It's 2.5%. For 2024, it's 2.5%. So why really go in all this tightening path? And the projections for the appropriate level of interest rates, it's 3.8% for the end of next year. This is too high according to our read. We think when inflation comes down, the Fed will proclaim victory and really will relax the pressure to hike rates to that aggressive rates. You mentioned 5%. We don't buy into that.
Okay, so what's the top terminal rate?
Well, terminal rate is also according to the Fed 2.5%. This is their long-term projections, which they didn't change. They didn't change much. We think it will be probably between 2 and 3%, and we don't see reason really to hike rates above the 3% level. beyond 2023. We think this year it's highly appropriate with the demand push, next year not.
David, thank you so much. David Kohler, Chief Economist at Julius Baer, joining me here in Zurich. Now, coming up, the Bank of England set to deliver a fifth consecutive rate hike today, with officials expecting to stick to a steady path amid global chaos. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Zurich. Now, in London, the Bank of England set to deliver its fifth consecutive rate hike today, with officials expected to stick to a steady path. The decision comes against the backdrop of a global rout in financial markets and soaring inflation. Well, joining us now is Bloomberg's Lizzie Burden, who's outside the Bank of England. So, Lizzie, how will the BOE balance the recent UK economic data? It was good for the doves and it was good for the hawks.
Well, Francine, we're not expecting the fireworks that we've seen from the ECB or the Fed. Of course, those decisions, it'll be too late to impact what happens on Threadneedle Street because the vote's already done. But they do have this difficult balancing act. It's between 25 and 50 basis points here. On the one hand, for the hawks, you've got CPI running at 9% in the UK. It's swallowing up wage growth. And since the last decision, we've had another £15 billion of fiscal support from the Chancellor, Rishi Sunak. Even he says that's going to be inflationary, even if it boosts growth. But on the other side of the ledger for the doves, the economy unexpectedly contracted in April. You've got consumer confidence down, the housing market's starting to slow, and you're seeing some of that tightness coming out of the labour market. So it's a recession in all but name here in the UK, and that's why our economists are expecting a cautious rate hike of 25 basis points, taking the key rate to 1.25%, and it'd be unprecedented in the bank's history to have 5 straight rate hikes.
Lizzie, thanks so much. Lizzie Burden there outside the Bank of England for us. Now, joining us now is Mel Stride, MP. He's UK Treasury Committee Chairman. Of course, the UK Treasury Committee has warned the government against unduly weakening financial regulation, with a panel of lawmakers even saying that the Treasury should not forget the lessons of the financial crisis. I am delighted to be joined by Mr. Stride, MP, Chairman of the UK Treasury Committee. Thank you so much, Mr. Stride, for coming in. When you look at some of the warnings that you've told government, have you seen some of the watering down of regulation that you worry about already being talked about or even put in place?
Not at this stage, because what's happened as we left the EU is that all these regulations have been brought into UK legislation, and they're going to then move down into the regulators, some of which, of course, those regulations will be amended in that process. So it's an ongoing process. I think we've seen some signs of actually quite positive change that may be afoot, particularly around something called Solvency II, which relates to the insurance sector and could have a very positive impact in increasing and improving their competitiveness and also levels of long-term investment in the UK. But there is a risk, as you said there, that this may be a time that government chooses to loosen up on regulation too much, and we mustn't forget the lessons of the financial crisis of 2008.
What particularly actually are you worried about? So if this is a preemptive warning to the government, is there something that they might do that really worries you?
So there's a lot of debate about what the objectives should be of our regulators, and there's been some talk that there should be a primary objective for both the FCA and the PRA here in the UK around competitiveness. In other words, putting a competitive advantage above prudence. And I think the committee feels that that could be a mistake, albeit that we think there is more scope now to have a secondary objective for both of those regulators around long-term economic growth. So there are opportunities here, but there are also risks if the government moves too far and too fast in terms of loosening regulation.
What kind, Mr. Stride, of moves should the FCA or PRA do to try and achieve some of the secondary objective to promote long-term, of course, economic growth, but also financial inclusion?
Okay, so basically it's a case of a case-by-case basis where they look at regulation, and there'll be thousands of different files of regulation that they're going to be looking at now over what will be several years. And it's really just a case of looking at each and every one of those and where changes are being considered to do that, not just in terms of their primary objectives, but also looking at how growth could be encouraged. Now, I mentioned Solvency II changes, for example, and without getting into all the technicalities of that, that's a good example, because if there are certain changes made there that don't weaken the financial resilience in that area, but do encourage greater investment in long-term things like infrastructure in the UK, then that could be a very positive move. So it's that kind of balancing act that's important here.
I mean, I was struck by the fact that there's been, you know, after the market meltdown, a lot of talk about or reminiscing or thoughts that this could replicate 08. Do you see currently the financial system strong enough liquidity on the markets to avoid some kind of, you know, financial meltdown?
Certainly from the UK's point of view, when we've had the Bank of England before the committee and the Governor of the Bank of England and the Monetary Policy Committee, the question of resilience, I think the answer is that our financial system is very resilient. It's subjected to very stringent stress tests on a relatively regular basis. So I think the banks are well capitalised and in good shape. So I don't have any concerns on that front at this stage.
Do you have confidence in the Bank of England and the Governor, Andrew Bailey, to fight inflation?
Yes, I do, but that's caveated. So I think that the spike in inflation that we're seeing at the moment, which is going to rise here to over 10% in the autumn, is obviously a cause for great concern when the bank's target is just 2%. A lot of that spike is, to be fair, I think outside of the Bank of England's control when it comes to monetary policy. The bank cannot control the price of oil. It can't stop wars occurring between Russia and the Ukraine, or supply chain bottlenecks or lockdowns in China. A lot of the stuff that's external to the economy that's causing the inflationary pressure. But where I think it has been flat-footed is in the labour market, where we've ended up with a very overheated labour market, and we've also allowed inflationary expectations to run away with themselves. And I think there are some dangers here in the UK of a wage price spiral, with wages increasing prices, pushing up wages in turn. And I think the bank has probably been rather slow to react there. And the cost of that, of course, will be that they'll have to do even more on the monetary policy tightening side in order to bring everything back under control.
But overall, in the appearances of the governor, you've been reassured, I guess, by his presence. I know there's, you know, he's come under fire for certain comments about apocalyptic, you know, food prices, for example, or even the fact that you shouldn't ask for a wage hike so that inflation is under control.
Yeah, he sometimes chooses his words slightly clumsily. I think that's fair to say, and gets a difficult headline as a consequence. But look, you can't get away from the fact that there have been an extraordinary number of crises that have hit the world economy, the UK economy, not least the virus, of course, as well as all the other things that I've just mentioned. And it would be remarkable, I think, if any central bank or central bank governor had just glided through all that with fingertip control of every aspect of it. So I think we recognise the extraordinary challenges that he's faced. I think he's a steady hand at the tiller. He's got a lot more work to do, but the committee certainly has a very high level of confidence in the Bank of England and its governor.
Mr. Stride, do you think the Chancellor has to come back with an energy package, you know, soon, if prices continue rising at these levels?
OK, so that would be in terms of relieving the cost of living pressures that are going to hit a lot of people in the UK over the coming months. Now, he's brought in a package of 15 billion, which really will make a big difference. It's particularly targeted at those that are poorer households, where a disproportionate amount of their spending is on energy itself. So that's really important. I think the question really is, where do energy prices go over the coming months? And of course, they've been very volatile, and it is possible that maybe the conflict between Ukraine and Russia settles down or is resolved in some form over the coming months. And these are all things that are difficult to predict at the moment. Also in the UK here, once we get to April of next year, all the benefits here will be uprated by the inflation figure as it will be in September this year, which will mean a very significant real terms increase in benefits from April of next year. So the question really is, between now and April, does he have to do more? He'll want to wait and see what happens, I think.
Mel Stride, thank you so much for joining us today. Mel Stride, MP, they're chairman of the UK Treasury Committee. Now, coming up, we speak with Jeff Currie, Goldman Sachs, Global Head of Commodities Research. He joins us to discuss all things energy and commodities. That conversation at 9:30 a.m. UK time, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Zurich. Now, we're just getting quite a lot of movement when it comes to Swiss franc overall. Now, it's not just the Swiss National Bank taking the markets by surprise and hiking by 0.5 percentage points. I guess what's also concerning Swiss franc traders is that officials are no longer that troubled with the currency's strength, which opens, of course, the way for further Swiss appreciation. One way of looking at it could be Euro-Swissy, given also the pressure it puts on the European Central Bank and its patient stance amid the challenging environment. The other way would be to look at Swiss yen. Now, viewer from Mitsuho writes in, the Swiss franc is surging post the shock and S&B move, a classic market surprise. So we'll have plenty more, of course, on some of these central bank action. Coming up next, the one and only Jeff Currie on commodities. This is Bloomberg. The Fed takes aim at inflation. The central bank raises rates by 75 basis points, its biggest hike since 1994. The S&P follows suit with a surprise 50 basis point hike. We speak later with the former head of the Swiss central bank, Philip Hildebrand. The Bank of England is next, and risk sentiment turns sour as recession fears become the focus of central bank resolve, while stocks and futures are deep in the red. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Zurich. Now, crude oil up more than 50% this year due to upended trade flows after Russia's invasion of Ukraine, and it's only edging higher as traders weigh central bank action and rising U.S. output. Now, the International Energy Agency said on Wednesday that global supply will struggle to meet rising demand in 2023. Well, joining us now is one and only Jeff Currie. He's Global Head of Commodities at Goldman Sachs. First of all, Jeff, good morning. Thank you for joining us on yet another big energy and oil day. Is this much worse than you thought?
Yeah, absolutely. The markets move faster, and the fundamental tightness is deeper than what we would have thought 3 or 6 months ago. And I want to emphasize to everyone that this is not entirely a function of the war. These trends were put in place going back a decade ago. You know, the term we used is the revenge of the old economy. And it's not just in oil and gas, it's metals and mining, it's agriculture, it's the entire old economy space. In fact, I would argue it's anything capital heavy. We've ignored capital heavy in favor of capital light for the last decade. And this is what we're ultimately with severe shortages, across some of these really key markets that were exacerbated by the Russian invasion of Ukraine. So, this is where we should be, but it's a lot deeper than what we would have initially thought.
So, Jeff, is it going to get actually a lot worse? What kind of prices can we see?
I think, the upside, particularly in energy and food right now, as we go into the summer months, is severely skewed to the upside. Why am I going to argue that? One, particularly in the context of China, everybody's waiting for the recession. From a commodity perspective, we were in a recession in April and May. Metals demand contracted by 10%, oil demand contracted by 2.5% globally. Those are recession-like numbers. Well, it looks like we're on the backside of China as they come out of lockdowns. And I'm not going to say there's a green light, but the acceleration facing demand out of China between now and the summer months, particularly given the fact that the stimulus that they're putting in the system is the third largest since the financial crisis. So one, China. Two, Russia, the sanctions are likely to start to bite more deeply as we go into year end. We'll see if they actually implement them, but it's going to tighten it from the supply side. Then let's not forget, people haven't been on holiday for 2.5, 3 years, that the travel season this summer is likely to be, it already is, a record level in terms of just looking at airline tickets.
Jeff, but when you look also at oil, refining is without a doubt one of the biggest, if not the biggest problem in the oil markets right now. So how will that pan out? Is there any side to the capacity crunch?
Well, when we think about where the shortages coming out of Russia, it's in the refined product side, more so than it is in the crude side, because essentially have taken those refineries off the global market. Now, when we think about the ability to bring on refining capacity, that takes decades, and there's nobody who's actually built a new refinery in the West since 1977, which is an indication growing the supply here is not something that's very, very easy. You know, you look at the Chinese and you look at the Russians, that's where most of that spare capacity exists in the world right now. So when we, look at the policies being implemented in the U.S. or talked about in the U.S. right now, about responding to the record margins, let's remind, this is a global problem. It's not a local problem in some place like the U.S. And the ability for the U.S. to unilaterally fix this problem is severely constrained.
So, Jeff, does it mean that actually product price will be much more elevated than crude for the next 5 years? Can it be longer? Like, what's worst case scenario?
Well, we think you're going to see some normalization in the product cracks as we go in this year, as refineries come out of turnaround and you debottleneck some of these refineries, because they can debottleneck them, put investments into the existing refinery to make it process more crude and produce more product. But it's, to give you an idea, historically, you just take a gasoline crack, it trades 20-25% of the crude price. Recently, it's been 45-50. So let's say we get a normalization down into that, 30 to 40 range. You kind of get the idea. It's not all the way back, but it's not nearly as high as what we're talking about right now. So, but I think the key point here is it gives us the revenge of the old economy. Underinvestment in refineries, underinvestment in oil production capacity, trucking problems, shipping problems. I can keep on going down the list. Copper mines. Basically, we favored short cycle iPhones over copper mines for the last decade, and this is the shortages we're ending up with.
So, Jeff, there's very tight supply, or, the supply-demand dynamics are going to be very tight for 2023. What happens after that? And what happens to your forecast if we actually get a global slowdown?
Well, the global slowdown, let's say it's Fed-induced. I want to emphasize demand destruction or demand slowdowns is not a fix to this problem. It may be a temporary solution and it may create a pullback in prices, but it's not a long-term fix. There is only one long-term fix to this problem, and that is investment, harnessing large amounts of capital into this space to debottleneck it. I don't care if it's growing supply through actual investment in production capacity or it's through productivity gains in technology. Both avenues require investment. And at this point in the game, we still don't see large-scale investment. We see outflows in commodities. The equities are trading with free cash flow yields of 25, 30%, record free cash flow yields across the entire old economy. And then you look at credit spreads, they're widening in a $120 environment. So the net of this is telling you we're still not seeing the capital flows. Now, what are the reasons for the lack of investment? Number one is a history of bad returns. Most people are pretty scarred by the experiences of the last decade, so no wonder there was no capital. Number two, the volatility is too high, that scares people away. And then number three is ESG.
Yeah, right. And Jeff, I wonder whether then at this point we'll see any more capex given also the transition. But are you expecting more oil from OPEC plus once President Biden meets with the Saudis?
Let's just go over, potential spare capacity, somewhere a little bit north of 2 million barrels per day between Saudi Arabia and UAE. We look at the loss in, let's say Chinese demand is down somewhere around 800,000 barrels per day. It rebounds. Seasonal uptick in demand is 3 to 4 million barrels per day. The potential right now, Russian supplies are down about 600,000 barrels per day, likely to be down 1.5 million barrels per day at year end if the sanctions are imposed. So the net of that is a lot more than 2 million barrels per day of required, just call on OPEC or, supplies more broadly. So, and also let's remember, there's 1 million barrels per day potentially coming out of the SPR right now, and that starts to run out relatively soon. So you really have to ask, where is this supply going to come from? And let's not forget, you have shortages in grains, shortages in gas, and then they siphon off one another. What was the immediate fix to the gasoline problem in America? Take from the corn supply, move ethanol in. Eventually, we're going to have, really serious shortages.
But it's always a timeline problem, isn't it, Jeff?
Yeah, absolutely. I just want to say, longer term, we need to get capital. And Volcker took interest rates up, the 20% in 1979. It was off the back of 6 years of CapEx. We don't have that CapEx right now. So the terms of thinking about how long it's going to take to fix this problem. Here's another important point. Don't expect that the interest rates can come back down. You basically need to have a situation in which not only are you slowing demand growth with the higher rates, but you're then saying, hey, world, don't invest in things that are all short cycle. Going back to my iPhone versus copper mines, you end up having to move more capital into oil production, copper mines, and all of these capital heavy entities.
All right, Jeff, thank you so much. Jeff Currie, all fired up there, global head of commodities at Goldman Sachs. I want to also get back to Jeff and ask him about Exxon and the comment we heard from President Biden on Exxon making more money than God. Coming up, big and bold moves from the world's leading central bankers as they feel the pressure to tackle surging inflation. More on the Fed and the ECB next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Zurich. Now, we had a pretty exciting S&B. I have to say there was a lot of market expectations on what they do, but despite the market expectation, they still surprised a 50 basis point hike. Now, central banks had one of the most significant days and weeks in recent history yesterday. The Fed hiked rates by 75 basis points, the biggest hike since 1994. The ECB held an emergency meeting and set about creating a new tool to curb market stress. That's after Italian yields surged to the highest since Europe's sovereign debt crisis. Now, just over an hour ago, the Swiss National Bank also unexpectedly increased interest rates by 50 basis points for the first time since 2007. Officials responding to a pickup in inflation that they fear can actually get out of hand. Now, on the back of the news, the Swiss franc surging 2%. With us, the BlackRock Vice Chair. He is Philip Hildebrand. He's one of the greatest minds when it comes to inflation. He's also former S&P president. So, Phil, you're like Phil, I've never called you Phil before, but you're like the dream guest when it comes to inflation.
Good morning, Francine. It's great to be here.
Philip Hildebrand, you've always come on and said, look, we shouldn't worry too much about inflation because it's a supply shock and actually it will kind of readjust. The markets now seem to say, look, they got it wrong. They should have acted quicker. Have you readjusted your inflation expectations?
No, I think the key is that we live in a world shaped by supply. In the past, it's always been about demand. This is a different world. The great moderation is over. And what it means for central banks, principally, I think, is that you can no longer automatically stabilize both inflation and output. There's a trade-off involved here. That's the effect of having the world shaped by supply forces, and this is what's been driving this inflation. So what we have to understand, and markets are coming to terms with this, is that the more aggressive you focus on inflation, the more you're going to have output volatility and stress in financial markets. The days of kind of the divine coincidence when if you stabilize inflation, you would also automatically stabilize output, those days are over.
So are you telling me that the Fed cannot engineer a soft landing?
I think it's very unlikely, exactly. I mean, this is the key, and in my mind, what's been missing a bit from the communication framework of most central banks is to acknowledge that we're no longer in the great moderation period. This is a different era, a different regime, and there's a trade-off involved. And you have to start to talk about this and say, yes, we can aggressively raise interest rates. Yes, eventually we could get inflation down, but it comes at a cost. There's a trade-off involved in terms of output and in terms of, as we're seeing, financial markets.
So do you believe that the Fed is now maybe too aggressive? Are they right to be as aggressive to actually try and deal with inflation? Or will it push the U.S. in a recession?
I still think there are two topics here. One is, should we get out of this very expansionary monetary policy? Absolutely. That's why I think what we saw this morning across the street here makes perfect sense. We need to get to normalizing rates, right? And as quickly as possible, frankly, in my mind. Beyond that, it's a whole different story. That will not be enough to get inflation anywhere near the levels we had before. And so then comes the question, what do you do? Do you really go into very tight territory? Do you aggressively tighten monetary policy to get inflation down? You'd have to tighten it, I think, very aggressively to do that, given the supply side nature of inflation. And that's when you have to start to acknowledge that there are trade-offs.
Let's focus on the Fed, because I do want to also really speak about the S&B with you at length. But on the Fed, what's the terminal rate? So if inflation's at 10% and gets stuck around that level, are we going to see interest rates at 5% or beyond?
First of all, I believe inflation is peaking as we speak, and so we will start to see inflation coming down. And it's going to be lower in 6 months, but it will still be much higher than what we're used to. And that's when the issue comes.
Levels?
No, it'll be significantly lower than where we are today, but it'll be far away from 2-3% or whatever the target might be in different countries. So, and that's when the issue comes up. My sense is that in the end, because of these trade-offs that I talked about, we will end up seeing cumulatively less interest rate hikes than what many people are thinking right now. Because the cost of it in terms of output, in terms of market volatility, will simply be too high.
I was going to ask you about market volatility. Do you worry about liquidity?
Well, liquidity is going to be an important point, certainly. I mean, in this world where we're no longer in the great moderation, where there is a trade-off, there will be great volatility. You can't just stabilize everything just by stabilizing inflation. That means market participants have to brace themselves for volatile markets. We're seeing it again this morning. And that means, of course, as a market participant, you have to focus on liquidity, because what you don't want to do is get caught up in a volatile, uncertain market with limited liquidity. So I think the focus on liquidity will be very much a dominant theme amongst market participants.
But is that something ugly could happen? What did we live through on Monday? I mean, some traders were almost making parallels with 2008. Now, I know it's very different in nature, but it was, a pretty big wake-up call.
Yeah, because this is very different than 2008. The financial crisis was a huge shock, but it was a classic demand shock. What we're seeing here, this is an economy shaped by supply. And so therefore, the reaction to tightening will be very different. And that's what markets have to embrace.
But what you're telling me is that then all bets are off because we've never seen this before.
That's right. I think this is, this is an entirely new regime. The great moderation that Ben Bernanke and others coined beautifully at the time, that period is over. It's behind us. And frankly, central banking is much more difficult today than it was for my generation.
So this means what? That we could have a further correction, even a 10% correction across the board of all asset classes once markets realize this dynamic?
If the central banks were to choose to really drive inflation back to the targets, they would have to raise rates very, very aggressively and would not be able to stabilize output at the same time. And so until they clarify this trade-off story and where they see themselves with regard to this trade-off, I think markets will remain vulnerable.
Is SNB symptomatic of that? Is it a wake-up call? Because inflation in this country, in Switzerland, is only at 2.9%. So the fact that they surprised the markets, then I think one economist out of 20 was expecting a 25 basis point hike, and yet they hiked 50%, symptomatic of the fear among central banks.
I don't want to get into the tactics of what was done here, but certainly normalizing makes perfect sense for the Swiss National Bank, as it does for all central banks, frankly. We're in this restart dynamic. We don't need rates where they are currently. So there's no question in my mind that they should all normalize relatively quickly. The issue is what comes beyond that. At the moment, the rhetoric, particularly from the Federal Reserve, is very much focused. We're going to break this inflation as if it were a normal cycle. In my mind, what will be required in the weeks to come is start to talk about this reality of the trade-off, that you can no longer automatically stabilize output if you stabilize inflation. And there's going to be a significant cost factor involved here.
So go to cash.
Or gold? I'm not sure, but I think what we need as investors, we need guidance from the central banks as to how they see the reality of a world shaped by supply that means you're going to have trade-offs.
Philip Hildebrand, thank you so much. The Vice Chair of BlackRock stays with us, and we'll talk a little bit more about the Swiss dynamics and, of course, some of the talk about parity with the euro, or whether all is to play between Swiss and yen. Now, the Bank of England also set to deliver a fifth consecutive rate hike today. We'll have coverage on this throughout the day, but more with BlackRock's Philip Hildebrand is next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Zurich. Now, we're talking about the S&B. I'm here, of course, covering the decision. I was told this is the most exciting S&B decision in modern history. And I have to say, I was not disappointed. They surprised and hiked by 50 basis points. Let's get back to Philip Hildebrand, Vice Chair of BlackRock in a former life, of course, also President of the S&B. What do you do with the currency? I mean, what if you look at Switzerland, so I guess this is one of this idiosyncratic things where a little bit of a higher Swiss franc is not something to be snubbed at given the inflationary pressures.
Yeah, I think at the moment Switzerland is in a relatively comfortable position with regard to inflation. Monetary conditions because of the currency are tighter than elsewhere. And, you know, that's on balance, I'm sure, a welcome development from the perspective of the Swiss National Bank. Nonetheless, monetary policy ought to be normalized, and so I think today's decision is perfectly sensible. There was a window that opened up, and you know, we don't know how long these windows will last, right? This is my point about the trade-off, and so I can see why they did what they did.
And then yesterday we had the ECB. I mean, this is when your expertise really comes in play. It's all of these, you know, interdynamics between the central banks and what markets will do. Where are we seeing, or where will we see the biggest dislocation? If we look at fragmentation, the fact that ECB addressed it but vaguely, is the market continuing to test that?
I think what these cracks in the market, whether it's the peripheral story in Europe, whether it's equity markets or the yield control issues in Japan, you know, all of this shows the cracks are beginning to appear, which in my mind is exactly underpinning what I said earlier, that we are no longer in the great moderation. You can't just assume that by stabilizing inflation, everything else will stabilize. This is a very different world from the last 40 years. And as you do that, you start to have a cost as a trade-off involved. And I think what we're seeing, what we saw yesterday, is a perfect manifestation of that. And of course, you know, central banks need to start to talk about this and acknowledge it and take it into account in the decision making.
Why are markets not seeing this?
I think they are seeing it. In a sense, they're reflecting it through these cracks that are appearing in markets. You know, and what hasn't happened yet is this, the central banks haven't framed their communication in my mind, based on this new world shaped by supply and based on the fact that there will be significant trade-offs as you focus on inflation here. And at the moment, all central banks are almost in a, and I understand this, given the politics of it, in a kind of frenzy to prove to the world that they're going to get inflation down. That's fine, but they need to acknowledge that unlike in the past decades, this comes now at a significant cost to output and to market volatility.
But, you know, again, once they crystallize that, the markets latch onto that, and we start pricing in maybe the risk of a recession, what do markets look like?
Well, if they come to the conclusion that central banks will ignore this trade-off and aggressively tighten up to the point where you can essentially crush demand in order to get realigned supply and demand, I think we're going to see more of the market attention we're seeing. The alternative is that at some point, which is, I believe is likely, the central banks will have to acknowledge that the trade-off is very significant, the cost is very high, and they'll end up having to tolerate somewhat higher inflation for some time in order to manage this complicated trade-off story.
Philip, thank you so much. Philip Hildebrand there, Vice Chair at BlackRock. Now, we'll have plenty more, of course, on the markets throughout the day. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kriti Gupta in New York, Anna Edwards in London. The focus firmly, of course, on central banks. The focus firmly on how these central banks deal with inflation without going into a recessionary environment. Philip Hildebrand, once again, focusing on the supply side of things. And then I'll have plenty more, of course, on the S&B throughout the day. This is Bloomberg.
A big change from the Fed.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years.
I think the Fed really needs to send the message that it is going to crush inflation and do it as fast as possible.
They said they're going to move expeditiously, and they've kind of stuck to their word.
I don't think it was so much just the headline CPI. I think it was the fact that they were seeing signs of inflation expectations starting to become a little bit more suspect.
The question is if they'll be able to deliver on the path that they've laid out for the next couple of years.
I think the Fed's forecasts are still remarkably optimistic.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, June 16th. Our top stories today. The Fed raises rates by 75 basis points in the biggest increase since 1994 and signals it will keep tightening aggressively. The SNB follows suit with a surprise 50 basis point hike. Elsewhere in central banking, the Bank of England is set to deliver a fifth straight rate hike later today, with officials expected to stick to a steady path. And leaders of Germany, France and Italy arrive in Kiev for talks with President Volodymyr Zelensky. It's the highest profile visit to Ukraine since Russia invaded at the end of February. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Chrissy Gupta in New York. Kailey Leinz is off today. And Chrissy, what a day it has already been if you're just waking up in the United States. Sentiment here in Europe was already not great as we were getting started for the trading day. And then we got that surprise huge rate hike from the SNB.
You know, of course, it follows a lot of the turmoil that you're seeing in Asia. Let's go there and talk about the overnight action, because a lot of this has been simply a function of digesting a 75 basis point hike. Take a look at this. The MSCI Asia Pacific Index down again about 0.2%. But look, the volatility within that region is what really stands out, because if you actually look at what the different regions did, China, South Korea, they all sold off. But Japan, the Nikkei, actually gained a little bit, up 0.4%. And we know that's really been the region to watch when you're talking about the weakness perhaps in the yen, the weakness that you're starting to see in terms of the BOJ trying to really keep up with that hawkish temperature you're seeing around the world. But take a look at this. That I mentioned that weaker yen. Well, today it's a little bit stronger. Once again, reversing some of the trades that you've seen in the last couple of days. This idea comes back down to, even with these record imports, these record energy prices, can the BOJ actually seem to maintain a grasp on their bond market? And for now, for a very brief moment, Anna, it seems like they can, in light of those 75 basis point hikes. Whether they can actually keep that is a different story, Matt.
Yeah, we're going to find out overnight. What an insane week for central bank action, right? We get 75 instead of 50 from the Fed. We get an emergency meeting from the ECB, and now we could have the BOJ pulling an SNB, and we got an SNB pulling an SNB today. Right now, S&P futures down. This is really interesting because we're off big time, right? Almost 2.5%, more than 2.33% right now on futures. Yesterday, we rallied in the cash trade because the narrative was the Fed is finally getting control, finally going to quell inflation. Today, the narrative is, well, that's going to cause a recession. The U.S. 10-year yield rising as investors sell off this debt because later debt is going to come with a much bigger coupon. Right now, 338.31 is the level on the 10-year, but you can expect that to continue going much higher. NYMEX crude keeps coming down, which I guess is good for global growth, right? 114.95. As Joe Biden prepares to go to Saudi Arabia and talk to MBS maybe about getting some more oil. And then Bitcoin not doing a heck of a lot right now, 21,679. At least it's gaining, right? The concern was that it would fall down through a $19,000 support. And then the next support was below 15 or something, maybe even 0. So at least a little bit of good news for Bitcoin, and it's not correlated, it looks like, today, but really it's all about central banks, right? That action just moved charts across the globe, Anna.
Yeah, absolutely. It's had a really big impact here in Europe. And it was interesting, in the first part of the trading session here in Europe, we thought maybe we'd get a little bit, Matt, of the post-Fed bounce in risk appetite that you were referring to there. But that certainly didn't happen. That certainly didn't last long. We were feeling negative sentiment coming through. NASDAQ futures were deteriorating even before we got the SNB hike. And then we saw the SNB hike and European stocks take another leg down. FTSE MIB down by just over 2%. The DAX down by 2%. The CAC 40 down by more than 2%. So this has taken the edge of risk appetite here in European stocks. This is the impact it's had on FX markets. We saw the Swiss franc jumping. This is the Swiss franc against the euro, and it jumped as a result of what we heard from the SNB. There were so few people expecting 50 basis points from the SNB. A few were talking about 25, but the sentiment or the consensus had been that we'd get actually no change. Well, that seems to have been blown out of the water, as has the assumption that the SNB would wait for the ECB to go first. That had been the sort of market's thinking previously. This is the German 5-year yield. We're seeing yields on the rise here, but this is not about spreads widening. That was the story of a couple of days ago, of course. This is the link between what the SNB is thinking about the ECB here and what the ECB is actually doing. So if the market is moving closer to a way of thinking that if the ECB has a fragmentation tool at its disposal, then it can do more rate hikes. Maybe the SNB thinks that's coming. And as a result, that's what the market is thinking. And we saw a jump in yields at the 5-year here. This is Germany, but we could have put in here Italy. We could have put in France. All across Europe, we're seeing those yields going higher. Natural gas prices also going higher, up by 7.8% this morning. We have all of these leaders, European leaders, making this really historic trip to Kiev at this time to meet the president, Zelensky. And Russia chooses that moment to cut back on flows, not cut back entirely, but reduce flows through the main pipeline. This is gas pipeline from Russia into Europe. ASOS, this is an online retailer, Chrissy, here in the UK. And for anybody who's thinking, well, all of that macro chaos can stay to one side, I'm focused on corporates and they still have strong balance sheets, and consumers, yeah, they're feeling the pressure, but they've still got savings. Well, this is a cautionary tale from the retail space. Yes, there's competition for this business to keep in mind, but actually we're seeing very gloomy forecasts coming through from online retailers here in the UK now. This is ASOS. We also had a negative statement from Boohoo, which seems appropriate. Chrissy.
And ASOS, I didn't know it was a British brand. I think every American girl probably knows what ASOS is. Let's take a look at what's ahead today, though, and talk about those macroeconomic risks. German Chancellor Olaf Scholz, French President Emmanuel Macron, and Italian Prime Minister Mario Draghi are all in Ukraine for talks with President Zelensky. Senior European officials see little chance Russia will strike a deal to let Ukraine resume crucial grain exports. We'll get some U.S. data as well, including housing starts and initial jobless claims right off the heels of that Federal Reserve decision from yesterday. And speaking of those central banks, it's the BOE's decision, the Bank of England coming in at 7 a.m. New York time. Of course, we'll have that live coverage for you. And don't leave just now. We'll get the Bank of Japan decision overnight as well. Crucial, Matt, in terms of the central bank palooza we're seeing this week.
Yes, I like that. Central bank palooza. I'm going to stay up all night for the BOJ decision for sure. Let's get to our global team coverage of central banks. Francine Lacqua is in Zurich on the Swiss National Bank, Michael McKee here in New York on the Fed, and Lizzie Burden in London on the BOE. We'll start with Francine because that was unexpected, right? An increase in rates for the first time since 2007, and of any bank, the biggest first hike that we've seen so far in this cycle, Francine.
Yeah, this was so un-Swiss, but actually I flew into Zurich and a lot of market participants were like, this is the most exciting S&B meeting that we've seen in modern history. Well, they did not disappoint. So they hiked unexpectedly out of 20 economists. One, and that was Citi was expecting a 25 basis point hike. We got 50 basis points. Now, the underlying reason, Matt, is of course they don't want to be left behind in this global tightening cycle. They worry about inflation. But remember, inflation here in Switzerland is 2.9%. So, of course, it's above their target, but it's peanuts compared to the rest of the world. So the question is, what does that mean for the Swiss franc appreciation? This was one of their main concerns in the past. And I think one of the other things, and this is something that Pictet just came out and asked in the Twitter sphere and also to a lot of their researchers, was this coordinated? We had a big day yesterday. We had a big week overall. And is this actually central banks coming together in IMF and saying, guys, we need to individually do something quite strong to show the world that we mean business, which is why we got the Fed. We did see the ECB on fragmentation. And today we have SNB as well.
All right, Francine, thanks very much for that. Francine Lacqua flew into Zurich, especially for the surprise hike. We got another hike out of the Fed, this time 75 basis points, the central bank's biggest hike since 1994. The chair, Jerome Powell, asserted the Fed's commitment to reining in price pressures, indicating another big move in July.
We're strongly committed to returning inflation to our 2% objective. Inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common.
So just back from Washington, D.C., our international economics and policy correspondent Mike McKee joins us for more on the rate hike. Mike, pretty fascinating week for central banks, and the Fed didn't disappoint.
the Fed did not disappoint. As a matter of fact, they surprised, although they let us know on Monday through back channels that it was going to happen. The Fed has been watching inflation and were, according to Jay Powell, very surprised by Friday's CPI report in the United States, which showed the headline number up to 8.6%. And while the Fed looks at the core rates of inflation, Americans look at the headline rate because of gasoline and food. And with the headline rate rising, that pushed them into a big increase in inflation expectations, and that's exactly what the Fed is afraid of, and that brought on the 75 basis point hike, according to Jay Powell. Now the question is, what do they do in July? They've promised us another 175 basis points of tightening by the end of the year. The dot plot moving up significantly, and so they may do another 75 in July and 50 in September, which would leave them 25 to parcel out over the next couple of weeks after that, the next couple of meetings after that. But it's an open question, and a lot is going to depend on the CPI and PCE inflation reports that we get between now and then.
Mike, thanks very much. Bloomberg's Mike McKee on the latest on the Fed, from one central bank to yet another. The Bank of England is set to deliver a fifth straight rate hike today. Officials are expected to increase the key rate to the highest since 2009. Let's get more with Bloomberg's Lizzie Burden, who joins us from outside the central bank. 5 back-to-back rate hikes, Lizzie. That would be unprecedented.
It would, Anna, but I can't promise you the same policy fireworks that we've seen elsewhere in the world. You might ask whether the Fed decision last night would impact the Bank of England. Well, no, they've already had the vote, but as Mike said, there had been reports that 75 basis points might be on the cards for the Fed, so you never know what travelled across the pond. Here, though, the debate is more between 25 and 50 basis points, and that's because you've got inflation running at 9% here. It's swallowing wage growth. It's set to hit double digits later in the year. As the Treasury Select Committee Chairman Mel Stride said to Francine earlier, inflation expectations are getting out of control. People are losing faith in the Bank of England to do its job. And on top of that, since the bank's last decision, you've had another fiscal support package. But on the other side of the coin, the UK is in a recession in all but name. You've got the economy contracting, consumer confidence down, the housing market's starting to show signs that it's slowing down, and the same for the labour market. So our economists reckon you're going to land at 25 basis points, which some would say is pointless, others would say is cautious.
OK, well, hawkish surprises do seem to be the theme of the week, and the weak pound has been having an impact on inflation here in the UK, hasn't it, Lizzie? So we'll have to wait and see. Lizzie Burden reporting from outside the Bank of England. Thank you very much. Let's stick here in Europe. Natural gas prices in Europe jumped after Russia stepped up an energy war by cutting supplies. Meanwhile, Olaf Scholz, Emmanuel Macron, Mario Draghi have all arrived in Ukraine for talks with President Volodymyr Zelensky. Let's get the latest from Maria Tadeo, our European correspondent. Maria, we've got these three leaders then visiting Kiev, one of the most high-profile trips by world leaders to Kiev then. And on the same day as that, we see Russia cutting back on supply of gas to Europe.
Yes, Anna, and we have, of course, Mario Draghi, Olaf Scholz, and Emmanuel Macron now in Ukraine, that train that got there this morning. And Anna, whether you believe this meeting is a little too late, whether they should have done this weeks ago already. Remember, the Ukrainians have for months now also pledged and asked them, come to Ukraine, see it with your own eyes, what the Russian aggression has done to our country. The pictures that we have from this morning, they really are extraordinary. These are the three biggest economies of the European Union, of course, all deciding to do this trip together, fly essentially to Poland and then get this train to Ukraine to show this sign of support. Now, a lot of this, of course, has symbolic nature, but we are being told that in this meeting that they will have to, with the Ukrainian president, there will be a conversation about weapons. There will also be a conversation about the EU candidacy for this country. Remember, the Ukrainians have had a major reality check on NATO, but they still believe they can one day join the EU, and that is their biggest policy priority at this point. And then, of course, it'll be interesting to see the language that we get from the German chancellor. Remember, he's been criticized for being too timid on this, for being perhaps at times too conscious of the German economic environment and the damage that could spill over from the war. Now, it's also interesting, Anna, that this is happening in a day in which Russia has decided to limit some of the gas supplies into Germany, of course, criticized by the German government, saying there is no reason to do this, just further instability in the region, and Russia is now playing politics once again with gas.
Bloomberg's Maria Tadeo joining us from Brussels. We thank you as always. And from Brussels, let's head over to Washington. The House committee investigating the January 6th assault on the U.S. Capitol by a mob of Trump supporters. Well, it's back in session today after postponing a hearing yesterday. Jack Fitzpatrick, our Bloomberg government reporter, joins us now from D.C. for the details. Jack, walk us through what we can expect today and what the latest is on these hearings.
So today's hearing is focused on the back and forth between then President Trump and then Vice President Mike Pence. They're going to focus today, they have said, on the amount of pressure that Trump put on Pence to overturn the results of the election on January 6th. We're going to hear testimony from Greg Jacob, who is the counsel to Pence, and Michael Luddig, who was an informal legal advisor. They can get into the legal side of the back and forth and what Pence's understanding was of those voter fraud claims. We've already heard from a number of people that Trump was told that his claims did not have any legal merit. There is also likely to be video testimony from Mark Short, who is Pence's chief of staff. He may have some more information, not only on the legal side, but what Pence's team knew about any possible danger to Pence. In the first hearing, Liz Cheney cited White House aides who said that when told of a potential threat, even of hanging of the vice president, that Trump said maybe he deserved it. So we're going to get the legal side of the pressure that Trump put on Pence to try to overturn the election, but also potentially some more information about the danger to Pence and the relationship between Trump and Pence at that time.
Thanks to Bloomberg's government reporter Jack Fitzpatrick in D.C. Let's go from D.C. back here to New York and look at some of the stocks moving in the pre-market here, because this is going to be a very important story. If you see this broad sell-off in the market, what does the rest of it look like? And for that, I really want to look at Apple as this kind of proxy for tech broadly. If you don't have tech on your side, it's really hard to get those gains in the broader market. Apple shares already down to the tune of about 3% in the pre-market. Remember, higher rates are going to hit tech even harder. So Apple's really that proxy you want to watch for all of tech. But it's not just Apple. Let's talk about Tesla, because there are some fundamental stories in the play here. Tesla increasing their prices up to $6,000 across their lineup. That, of course, according to reporting, by Electric. This is really important as we talk about those macroeconomic issues that we've been hitting over and over and over again. Well, it hits companies like Tesla too, which does have a larger geographic exposure. Think China, think Berlin, of course, Austin, Texas here in the States. All of that is going to hit their bottom line. Those shares down less than about 4% in the pre-market. And of course, Kroger, one of the few stocks in the green this morning. This is important. They're reporting earnings later. We've heard about the retail mania. We've heard about the issues hitting a lot of those grocers with food supplies. Well, right now they're saying Kroger could actually come in and beat their sales report. We're going to have all eyes on that, Anna, when it comes later this morning.
Could that possibly be an area of calm? Kritty, thank you. Coming up on this program then, live from the Super Return Conference in Berlin, we will be joined by BC Partners Europe Chairman Nikos Stathopoulos. He will be talking to us a little bit later on in programming. Danny Berger on the ground for us in Berlin. Plus, a Fed-triggered recession may cost Biden a second term. Bloomberg Economics now places the risk of a downturn at 72%. Read more about that link between the economy and politics in our Big Take story on Bloomberg.com, or by typing NI Big Take onto your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kritty Gupta in New York and Anna Edwards in London. We are in the midst of an insane week for central banks. A surprise from the SNB to kick off the day today. Yesterday, we had an emergency meeting from the ECB. What was that all about? They got together to discuss the possibility of the justification for an extraordinary tool. I'm not sure, but if you look at Euribor pricing for ECB hikes, they shot up, and maybe that's why the SNB came out with its 50 basis point rate hike today. Let's talk about it with Dana El-Baltaji. She joins us out of London right now. Dana, what do you make of the emergency meeting yesterday? Is that what drove the SNB to this faster hike?
I'm not sure if the two of them are related, but I think what we can definitely see is that the central banks are realizing that they need to get ahead of the inflationary pressures. It's not enough to just do small hikes here and there. I think what they realize they need to do is to act quite aggressively in order to bring down this unprecedented inflation at a time when, we know that the economies are going to suffer, and we know that all of the reasons why the prices are going up can't really be helped locally. So they have to be super aggressive about it.
Yes, and with the ECB now giving us some sketchy detail about tools to tackle fragmentation, perhaps the path is clear for more rate hikes. We see the German 5-year yield heading for its biggest increase since 2011. Dana, thank you so much. More market analysis available to you on MLIV Go. That is the function to use on your Bloomberg terminal. This is Bloomberg.
Coming up, Hannah Gooch-Peters, Sanlam Investments Global Equity Investment Analyst. We're going to talk to her about the trade. We're going to talk to her about inflation. And this, of course, comes as German 5-year yields head for their biggest increase since 2011. What will Hannah say about how you play this market? This conversation next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed raises rates by 75 basis points in the biggest increase since 1994 and signals it'll keep tightening aggressively. The SNB follows suit with a surprise 50 basis point hike. Elsewhere in central banks, the Bank of England is set to deliver a 5th straight rate hike later today, with officials expected to stick to a steady path. And the leaders of Germany, France and Italy arrive in Kiev for talks with President Volodymyr Zelensky. It's the highest profile visit to Ukraine since Russia invaded at the end of February. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kailey Leinz is off today. And Matt, thanks to rate hikes that the market saw coming, but more importantly, rate hikes that the market did not see coming, risk appetite really deteriorating pretty quickly this morning.
Yeah, absolutely. I mean, we didn't even see the 75 basis point rate hike coming from the Fed until basically Friday afternoon, Monday morning, depending if you listen to Barclays or the Wall Street Journal. In any case, we were up yesterday, I think 1.5% in the cash trade on the S&P 500 because the market had already priced in that 75 basis points, and the narrative was that the Fed is going to get hold of inflation. Today, the narrative is that's going to cause a recession, and now we see pretty serious drops in S&P futures, 2.3% right now. Investors are also selling the 10-year, bonds across the curve right now, and that's pushing the 10-year yield up to 343.69. So levels that we hadn't seen really in over a decade. NYMEX crude is coming down right now, 114.48. Maybe the idea is, since China hasn't opened up yet, and if we're going to go into a recession, people are going to be driving less. I know I certainly will as I see prices at the pump. And then Bitcoin was up earlier, and I thought it was pretty cool because it was uncorrelated for the first time in weeks, maybe months, with futures. Now it's turned lower, but still at 21,249, well above the 19,000 and change level that Michael Novogratz has been watching out for. Kriti, what are you seeing in terms of pre-market movers?
Well, a lot of red on the screen, Matt, and this is really important when you talk about simply the proxy for that tech story. Apple, you got to keep looking at this, down 2.8% right off the bat. That yields picture, well, it is going to hit tech and it's going to hit tech hard. And take a look at this. It's not just Apple, Tesla as well, down 3.8%. But with Tesla, it's not necessarily a macro story, although perhaps you could say that it is. They are looking to raise their prices up $6,000 across their lineup. That's according to reporting from Electric. This is really important as we talk about how companies are going to actually perhaps pass on those costs that they're dealing from the macroeconomic sphere that you were just talking about. Let's talk about Kroger, though, because it's not all doomsday. There is a little bit of green on the screen, especially when you look at those retailers that can pass on those costs. Think about it. If you need food, if you need groceries, you're going to pay whatever it takes to get that food, and Kroger is going to be one of those beneficiaries. They're reporting those earnings later on today, and their expectation is they're not only going to beat those sales, Anna, but they're actually going to be able to pass on those costs even more.
whatever it takes in grocery and monetary policy. Chrissy, let's have a look at the European equity market picture. And stocks in Europe down by 2%. So to Matt's point about deteriorating risk sentiment, we certainly see that here in Europe. And actually, this was in train before we got that really unexpected hike in interest rates, 50 basis points from the S&P. Before that, we already had weakness on European stocks. We already had weakness on NASDAQ futures. So it wasn't all that, but it just reminded the markets of the threat of higher policy rates coming from global central banks. So stocks selling off. The euro on the move against the Swiss franc. This is the Swiss franc up by 1.7% against the euro as we see the central bank then in Switzerland surprising the market. The expectation had been that the ECB would go first, the SNB would follow its larger neighbour. That turned out to be the wrong sequence. The market knows that now, and the market had to adjust pretty quickly. Interesting to think about what this all means for the ECB. We saw them setting out some details, sketchy as they are, around fragmentation tools yesterday, or at least a focus on those fragmentation tools, and that seemed to put some calmness into peripheral bond markets. We still see that story fairly calm, but we do see a big pickup in the broader story around yields in Europe as a result of the assumption that if the ECB has the fragmentation tools, then that maybe means they can move faster when it comes to rate hikes. And so we see the German 5-year yield jumping to levels we have not seen since 2011. Gas prices also higher here in Europe today. We see a number of, 3 European leaders, the biggest European leaders from the biggest EU economies, making their way, and in fact they're there already, to Kiev to talk to President Zelensky today. And that's the same day that we see Russia cutting back on its flow of gas supplies from Russia to Germany. So we join a few of those dots, perhaps, Chrissy.
Yeah, and that's going to be a major concern when you're talking about simply what the trade is. I mean, going into yesterday's 75 basis point meeting or move, the expectation was that if the Fed does this, will it re-enlist confidence in the markets 24 hours later, or almost 24 hours later? And you can see that the futures, well, they're down 2.3% in the pre-market, at least here stateside. Let's get a little bit more color on what that actually means for the future of equities. Do we see that capitulation? Who better to ask than Hannah Gooch-Peters, Global Equity Investment Analyst at Sanlam Investments. She joins us now. Thank you, as always, for your insights. Let's talk a little bit about what the narrative is here. Now that we have 75 basis points, Powell perhaps talking about 50 or 75 in the next meeting as well. Can equity investors breathe a sigh of relief? And if not, or if they can, why are futures down so much today?
Now, look, I think when we saw the initial market reaction yesterday, I was starting to wonder whether or not this 75 basis points move was already priced in. Apparently not, and I think what we're now looking at is, due to Powell saying he's going to do what it takes to get inflation back under control around that 2% level, I think we're now seeing the real risk of another 75 basis point increase, and I think the market is now looking on that. We're looking at the effects of increased cost of capital. We're looking at effects on long-duration stocks in particular, and as we've noted earlier in the programme, we're now seeing, like the NASDAQ futures, for example, down around 3% today. So I think the market is still getting quite worried about that, and there could be some more downside to come.
Right, Hannah, good morning. So capitulation still lies ahead then. We haven't seen it yet. We've still got more downside for these global markets, it seems, and certainly US futures, as you suggest, pointing us in that direction. We're already in a global bear market for stocks. You wonder what it is that's going to suggest we are at the bottom. Does that not come until we get to a place where investors have really factored in all of the hawkishness that it's possible to factor in from global central banks?
No, look, at the risk of saying the worst thing I could possibly say, perhaps this time it really is different, because we're hiking rates into a stagflationary environment, and I just don't think that we're quite priced that in yet. I think that if you look at the discretionary sectors, for example, you can see the real pressures we're seeing on consumers globally. I think you're seeing financials starting to capitulate. You're seeing a really broad-based sell-off this month in particular. I really don't think there's anywhere to be hide. So for us, I think we could perhaps even see another 10% downside in the S&P in particular.
OK, and so how long, in that environment, how long does this laser focus on inflation, this hiking cycle globally that we're seeing, how long does it last?
No, look, I don't know how long it's going to last. I think that we could actually see a recession particularly come forward to perhaps the end of 2023. Now, I spoke before how it might be 2024, but, we're raising rates quicker than I thought we would. And so, and I think the market is having that same realization. And so I think things are coming forward a lot quicker than I thought we would. But, as you said, the market's reaction is very, very noticeable in the near term.
So Hannah, we're talking about then margin compression, to use a kind of jargony term, right? Which companies are going to feel it the worst, and where are equity investors safer to hide?
So look, we can see it already today. An example, we had ASOS's profit warning this morning. That is a company that was, if you bought it down in the lows of March 2020, you could have made over 500% of your money, but it's down 86% from its highs. You can see that pressure on the consumer. Companies like Amazon, for example, even Tesla, Apple, a basket of the biggest discretionary stocks in the world market from not holding those, the likes of Amazon, LVMH, Tesla this year, would have benefited a global investor over 2% in relative performance because they've been so weak. I think that's a part of the market that you are really starting to evidence these pressures on margins, for example, as you noted. We need to be looking to parts of the market that aren't as impacted by these inflationary pressures, and that's why we're seeing strength in large pharmaceuticals, for example, this year. Companies like Johnson & Johnson, Novartis in Europe, and even Bayer in Germany that are doing very well on a relative basis this year. But perhaps we have to start looking to other parts of the world too.
You know, having lived in Europe for 6 years, I still don't know what ASOS is, so I'm glad that Critty appreciates it. In terms of car makers with whom I'm very familiar, are we seeing, and all industrial or durable goods producers, are we seeing the supply chain problems solved? Are we seeing the chip shortage get better, Hannah?
No, look, I don't think we are. And I think semiconductors in particular were priced exceptionally high. If you look at the likes of ASML, NVIDIA, towards the particular start of 2021 for many of these companies were very expensive. And I just don't think that valuations right now in these car makers, for example, also the semiconductors, the larger parts of the supply chains are really quite pricing in these difficulties that we yet face ahead. They're coming off an exceptionally high base.
Hannah, thanks so much. Thanks for your time. Really good to speak to you. Hannah Gooch-Peters with their thoughts on global equities, Global Equity Investment Analyst at Sanlam Investments. Coming up on the programme, live from the Super Return Conference in Berlin, we will talk to BC Partners European Chairman. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking at a live shot at the Principal Room. Coming up later today, Galaxy Digital CEO Mike Novogratz. That's at 2 p.m. in New York, 7 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Critty Gupta in New York and Anna Edwards in London. And I'm kind of bummed out not to be in Berlin right now because the Super Return Conference is there. Normally, I go to that. Bloomberg's Danny Berger is there this year with Nikos Stathopoulos, BC Partners Europe Chairman. And Danny, you've been doing a fantastic job. Excited for this interview.
Yeah, Matt, me too. Look, I stole your gig. I stole one of your favorite interviewees. But so is life. That's right. We're here with Nikos right now. Nikos, thanks so much for joining. So last August, you spoke to Bloomberg, and you were pretty optimistic. You're saying, look, I don't think we're seeing any corrections right now. But I mean, the world is just so different from last August. Are you still optimistic?
I'm cautiously optimistic because naturally we're living in a very volatile environment. There's no doubt. Last August, I couldn't predict the inflation rates that we're seeing at the moment, and these are unprecedented. I've been doing this job for 25 years, and I have to say I have not seen inflation rates at this level, and I suspect most of my peers haven't. So we're living in an environment where inflation is much higher than we have ever seen for quite a while.
What does that mean? Obviously, it's hit public markets. What does that mean for private markets? Should they see the same drop in valuations that the S&P has, for example?
I would expect that we will, because the combination of inflation going up means that actually that will impact the profit margins of our businesses. It impacts the costs.
Have you seen any of that yet? Any cracks of that?
We have seen some of the pressure on costs and pressure on margins on the businesses. But interest rates as well will impact our business because they will impact multiples. And multiple appreciation has been a key driver of the returns in our industry. So I suspect that we will see this adjustment in valuations. There's always a lag between the public markets and the private markets, so it might take 6 to 9 months, but I think it will happen.
Yeah, I know Matt wants to jump in with a few questions, but first, Nikos, I just do have to ask. Bloomberg News reported recently that your latest fundraising target, you missed the target. What happened? What went wrong, if you can talk about it?
I think the timing was not conducive, frankly. I think the combination of that and the current environment didn't help, but it hasn't changed at all our strategy. It's consistent to what we had before, and frankly, we're continuing to deploy with the same discipline as we've had before. So nothing much more to say, frankly.
Matt, jump in here.
Yeah, Nikos, one of the great questions that Danny has been asking other PE executives at this conference is, what are the conversations like that you're having with your portfolio companies, especially given the rising rate environment that we're in and the acceleration of that this week, in terms of costs, in terms of investments? What are you talking about?
If I caught the question correctly, Matt, you're asking what the costs and what we see in terms of investment.
What conversations you're having with companies right now?
I mean, there's no doubt that the cost pressure on our portfolio companies is seen now increasingly, and it's coming from all places. It's coming from raw material costs, wage costs, etc. So a lot of our task at the moment is to manage this cost pressure. Sometimes you can do so by pricing. Sometimes you cannot manage it 100%. So I think you might see some impact on the profitability. And I think generally what this implies, we'll have to work harder in order to make money for our investors. And I think we do need to make better what we buy. So our job has become harder.
In this environment, is there any sector that you wouldn't look at anymore? Has that outlook shifted, that a once attractive type of company in this new environment is no longer?
I think certainly sectors which have a lot of consumer exposure are sectors that we're a bit more cautious about by definition. You know, consumer spending has been impacted. Inflation is impacting every household. Energy prices is impacting every household. So that is naturally going to impact the consumer spending, especially in countries, even in the U.S., where 2/3 of the GDP of the U.S. economy is consumer spending. So anything consumer-related, I think we're a bit more cautious at the moment. And we still invest in what we like to say being defensive growth sectors, like healthcare, like telecoms, media, like business services, where you can see that defensiveness, which we have been investing for 3 decades, and I think in this environment it's playing out even more.
Well, one of the things that this environment has done is the very bubbly type assets have suffered. I think of a Bitcoin. I know you're not there, not going to ask you about that space, but certainly SPACs had that feeling to it. Do you think those are just over now?
I think it goes to show that, this SPACs, I don't know if they're over, certainly has been much more subdued. There has been activity still in SPACs, not as much as it was before. And I think it goes to show that people are much more cautious. And in this environment, frankly, I think they should be more cautious.
How does that caution translate to exits, selling to another private equity or IPOing?
The deal activity has not really been impacted so far. I think it might be as we observe what's happening with central banks' actions, etc. There's so much money still in our industry, so I think we won't see that much impact short term. But I think everyone is in a bit of a wait-and-see mode to see what the impact this will have, mainly on valuations. I think all of our peers, including ourselves, have still a lot of portfolio companies, and at some point we will have to exit those. So I don't think this activity is going to stop necessarily, but I think as in everything, you have to adjust the valuation expectations of the buyers and the sellers, and they have to converge at some point, and that sometimes takes time.
Nikos, great to get some time with you. Thanks so much for joining us. Hope we can get you in the studio here in New York sometime this year. Nikos Stathopoulos there at the Super Return Conference in Berlin with Bloomberg's Danny Berger. Coming up later today, Greg Jensen joins us, Bridgewater Associates co-CIO. That's at 10 a.m. New York time, 3 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Matt Miller in New York and Anna Edwards in London. Matt, Anna, every morning Tom Keene asks me what my chart of the day is. Today, I have the distinct pleasure to ask him about his single best chart. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. Your single best chart, Tom.
Central bank roulette. Right now, the Swiss National Bank. I mean, it's really quite something to see what SNB did. I happened to be in Zurich with young John Farrow in 2015, the last time they did this. More drama then, but nevertheless, the chart speaks volumes. This is one of the most famous charts in the world. This is trade-weighted Swiss franc from 2007 with a massive appreciation of the Swiss franc. And then in 2015, they basically said, enough. And the success of their policy is the flatness. Slope matters on a log chart. And the real issue is with the price of the success of the Swiss model, massive appreciation. And since 2015, they have tried and tried and tried to manage the Swiss franc to a lesser appreciation. They threw in the towel today. Rates go up with the Fed, and maybe we'll see a stronger Swiss franc.
In terms of your guest lineup, Tom, what do you have today? I mean, it's hard to imagine beating yesterday's, to be honest with you.
Well, it's amazing right now. I mean, there's any number of news stories, including European leaders in Ukraine, which I think is just absolutely extraordinary. We're going to start strong with, well, the Bank of England. Elsa Lingos will join us, which is well-timed. And then on the market responses, Andrew Sheets will join us here as we stagger from central bank to central bank. When do we talk about the Bank of Japan?
Of course, something we're going to keep our eye on. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. A theme that you're going to hear across central banks, specifically in the Federal Reserve dialogue, is going to simply be unemployment. And that's really what I'm watching today. The slew of economic data, initial jobless claims, Anna and Matt, that's what's on my radar. The idea that as you have more inflation, as you try to tackle inflation, will the American public, will investors actually accept the concept that higher unemployment may be necessary to tame down inflation?
And it could go much higher. Right? I have to admit that I rushed home yesterday afternoon to watch John, Tom, and Lisa covering the Fed, and they had Scott Meinert on, who said, you know, the numbers that the Fed is working with are fantasy land, really. In terms of unemployment, it's going to go, I assume he meant much higher than they're forecasting. Nonetheless, what I'm watching is monumentally, historically important even. Ferrari is having its Capital Investor Day today, and they're talking about the electrification of their fleet. They're going to go with a full electric vehicle in 2025. They're showing the much-hated SUV, the Puro Sang, to everyone there, although they're not unveiling it to the public until September. And they're talking about all the money they're making. We got an inside pick of the Puro Sang SUV that Ferrari is making. You know, there was a time when Ferrari swore they would never make an SUV, and now they make one called Puro Sang. I just really don't get it, but it's going to be interesting for sure.
You see, I know you were torn today in this part of the program, Matt, where we tee up the things we're focused on, and I know that there is a part of you that is really obsessing about the BOJ right now. But I'm gonna go some way towards thinking about the BOJ. Well, not really, but I'm going to think about central banking at least, the Bank of England, and the Bank of England firmly in focus as we wait for a central bank rate decision. Another one in what has been an already busy week. Will we get a fifth back-to-back increase in interest rates from the Bank of England? That would be, as we heard earlier from Lizzie Burden outside the Bank of England, that would be unprecedented. It would take us up to 1.25%, which I cannot believe. I had to read this twice. That's a 13-year high for rates, 1.25%. So low have rates been for so long. Will there be three dissenters going for a 50 basis point rise, or will the Bank of England be held back by the fact that we've seen two negative prints on GDP back to back? That's month after month, so not quarter after quarter, but still something that could weigh on those policymakers. Or will they, Matt, catch the zeitgeist
I feel like
and go with the hawkish surprises?
I feel like the Brexit vote was 13 years ago. Is that right?
No, that was only six
years ago. And yet we're still dealing with the fallout. It's so lovely. We're seeing a lot of superlatives when it comes to central banks. And look, on Friday we had University of Michigan consumer confidence here in the U.S. out at an all-time low, which is one of the reasons that you're seeing the central banks move with such trepidation, right? It's hard to raise rates into that kind of issue. We heard from Lizzie Burden that the UK may already be in a recession, so it's difficult to raise rates in that environment.
Yes, and to Critty's point, we keep watching labour markets because they've been an area of brightness, of course. If that starts to show cracks, then that really does change the narrative. That is it for Early Edition. Still focused on central banks, on surveillance. That lies ahead. This is Bloomberg.